Oh boy, we're going to get ready to start stocks. Exciting stocks, sexy stocks, risky stocks. Slide number 1. Here's a popular email that was circulating around the internet in around 2002. If you had invested $1,000 in Nortel Networks stock last year, you would now have $50. Instead, if you had purchased $1,000 of Budweiser beer, drank the beer, and returned the cans, you would have $78. So our stock tip for today is to start drinking heavily. You know, this joke was circulating around 2002 or so because Nortel Networks had lost 95% of its value, along with a bunch of other companies, many of which disappeared never to be seen again. They were called the dot-coms, and then they were called the dot-bombs. And you know what? History might not repeat itself, but it sure does rhyme. In 2009, the same email was circulating, except it was replaced with AIG, American International Group Insurance Company, or Citigroup, or WAMU, or... Soon we should see super microcomputers substituted into the joke. Yes, stocks can make us very wealthy over time, but in the short term, they could make us very sad. Slide number 2. What are stocks? What a stupid name. I mean, if I were king of the world or dictator or emperor or whatever, I would ban that word stock. Businesses, specifically corporations. And you'll learn about different types of businesses in Introduction to Business, BUS121 here at Southwestern, or somewhere other place we learn about businesses. Stocks are equity financing, which is a fancy word for ownership. That's the word we use for ownership in accounting, equity. So they are very different from bonds, which are debt financing, where you're loaning your money to when you invest in bonds. Think of them like mortgages. Stocks, you're a part owner, so you too can partake in the growth of a business or the economy as a whole, depending on how you invest in stocks. Why do corporations issue stocks? Well, there's various reasons to raise money to start or expand a business. You got a great idea, you need capital, fancy word for money or resources. Where are you going to get it? Well, no bank's going to lend it to you. So you raise capital through the sale of stock. You sell parts of the corporation to the general public. Some companies, like many of the companies here in San Diego that are biotech companies, they issue several series of stocks because they need to keep paying for the ongoing business. You know, it's going to cost them $600 million to make that drug that may or may not cure baldness. They ain't going to get the money from the bank. They can't sell bonds, so they sell a piece of the company. Once a company is large enough, it's just a way to gain prestige and respect. There's a few very large private companies, but not too many. In fact, the folks who started Google were not sure that they wanted to go public, until the boys and girls from Wall Street came knocking on their door, waving billion-dollar bills in their face. And they said, oh, okay, yeah, we'll go public. And of course, as a method of payment for those who start the firm. So would you work day and night, 7, 8, 9 years and get that baby off the ground and start a public company and walk away with hundreds of millions or maybe even billions of dollars? Well, for every one Google, there were a dozen or so: Altos, Lycos, Go, Ask Jeeves, Yahoo. Yahoo's still around, but its search engine is pretty pitiful. And of course, the only people who are big enough to take on Google are Microsoft and Facebook. Facebook. Right. They're the only two other search companies that can take on Google. And even then, my understanding is Google's still better. I think it's better. Anyway, that's my opinion. The corporation doesn't have to repay the money, but the corporation is now a public entity, and as such, it has responsibilities that private companies simply don't have. They have to publish their financial statements every 3 months, so that the public can know what's going on. And even then, you don't really know if it's really true. And sometimes they don't even know. They're like, well, this is what we think it is. We might have to restate those earnings, because these corporations are very, very large. Why do investors purchase stock? Well, you get to share in the success of the corporation. And a very cool thing that you would learn more in a business law class or an introduction to business class: when you're part owner of a business, if it's a sole proprietorship, that means you and the business are the same, or it's a partnership, you're on the hook for any liabilities that the business created, incur any liabilities, any debts. But if you are a shareholder in a corporation, assuming there's no hanky-panky going on, no, you're limited to your investment. So you bought one share at $100 and the company goes bankrupt. That's it. You lose your $100, but they can't come after you for more money. Now, there are some people who obviously are going to try to game the system and get away with that. And that's where you might hear the term piercing the corporate veil. Somebody creates a corporation and hides all their assets somewhere else, puts all the debts in the corporation, and then declares the corporation bankrupt. Well, if you did that, there are people called forensic accountants who will go in and see that you committed fraud, basically, and the bankruptcy judge would be very, very upset with you. One of them was president and then is running again for president. Anyway, what else do you get? Here are two wonderful things: income from dividends and dollar appreciation of stock values. And that's what most people consider. That's what most people think of the capital gains. But dividends don't lie. Dividends are distributions of the earnings to the shareholders. And so your total return is equal to your dividends plus your capital gains. Now, some people will say, oh, you get a possible increased value from stock splits. That is not true. A stock split is an accounting maneuver. And we're going to ask you a question on the assignment, so take a look at this carefully. There is no increased value from stock splits. If you had one share at $100, you might now have two shares. But wait a minute, the price went down in half because it can't change the value. One share at $100 is worth $100. If they give you another share, a 2-for-1 split, for every one share you have, now have two, the price is going to go down $50. It's a psychological increase at best. And I've noticed that many companies will split their shares just to tell people that they think things are going well. Because if they say things are going well and they don't go well, they could get sued. Our litigious society. So that's why you'll see companies split their stock. And there's a historical reason that we're not going to get into. But for many years, Warren Buffett just basically said, since the 1960s, I'm not going to split my shares. And a single share now goes for almost $700,000. Right. Well, he's done very well for his shareholders and himself. But if you had purchased a single share of Colgate, 100 years ago or so, yeah, your one share would have split many, 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 many times, and you'd be sitting on, maybe over $1 million. One woman bought 3 shares of Abbott Labs when she started working there. She was 23 years old, and she never sold them. They just kept splitting and splitting and splitting. And when she passed away, they were worth $1.2 million or $1.3 million. There's an article somewhere online here. Either maybe it's just for Business 123, but it's there. And she was something. She worked there her whole life and never sold her shares, and then donated them, I think, to a charity. So that's why you purchase stock. But what can we expect from our shares? Well, historically, stocks have returned about 8, 9, 10%. That's what I tell people. Actually, some have done a whole lot better. Some have done a whole lot worse. But I tell them 8, 9, 10%, even though we're going to see some stock investments that have done better than 10%. Traditionally, half of that return was from dividends. Shareholders used to expect 4 to 6% in dividends each year, and that was as much or often more than bonds returned in interest, since stocks were considered much riskier than bonds. But what happened in the 1980s and 1990s, and continues to this day, is that dividends are taking a back seat. They fell to a low of 1% in 2000 because people said, I don't want dividends, we want capital gains. So companies juiced their finances so that the capital gains were more emphasized than the dividends. And it says currently dividends are just under 2%. Actually, I think they've gone down to almost like 1.5% or maybe a little bit less. So maybe we should update that. And this has led many experts in the field to say that we're in a bubble, that we're in a stock bubble. But they've been saying this now for 20, 30 years or so. So I don't know. And, some savings accounts are paying 1% or 0.5%. So, whoopee. So, yeah, I love dividends. We're going to see some companies that do pay very rich dividends. And that's why I say dividends don't lie. But you're going to notice that more stock investors get excited about the capital gains. If stocks are the best long-term financial investment, how come they're considered so risky? Well, it depends. For 2 decades after the crash of 1929, we're not in 2029 yet, stocks were regarded as gambling by the majority of the population. This impression wasn't fully revised until the late 1960s, because in the 1950s and 1960s, the stock market went in 2 directions, up and way up, when stocks once again were embraced as investments, but in an overvalued market that made most stocks very risky. Is it too late to get in? Is it too late to get out? Historically, stocks are embraced as investments and dismissed as gambles in routine and circular fashion, and usually at the wrong times. Stocks are most likely to be accepted as prudent at the moment they are not. Now, I added the emphasis, but that's Peter Lynch, who wrote a phenomenal book called One Up on Wall Street, and he was one of the world's best money managers. Very, very down-to-earth guy, dry sense of humor. Read his books, and they're in the bibliography for Business 123, Introduction to Investments. He called it his cocktail party theory. He would go to a cocktail party, and they would be introducing themselves. Oh, you're an architect. Oh, interesting. Oh, you're a money manager. And they all move away from him. They didn't want to talk to him. He'd say, okay, good time to buy. And then he'd go to a cocktail party. Oh, you're an engineer. That's great. What are you, a money manager? Oh, really? Do you have any stock tips to share? And that's when he knew, okay, market's probably fairly valued. And then he'd go to a cocktail party, and someone would say, oh, I'm a doctor. Okay, I'm a mutual fund manager. Oh, really? Well, I just bought this stock. Somebody told me it was going to double in 8 months. I don't really know anything about the company. In fact, I don't even know the name of the company, but I do have the ticker symbol. That's when he knew we're ready for a crash. When people who, maybe fabulous doctors in their field, or lawyers or mechanics or teachers or whatever, when they're giving the professional money manager, the professional stock picker, tips, that's when he knew, is it too late to get in? Yeah, it's too late to get in. So let's take a look at the rolling 10-year periods from the Great Depression. And this is a very revealing graph, in my humble opinion. Why? Because it shows you that stocks, as Peter Lynch said, are routinely dismissed as gambles and then embraced as prudent investments at the moments they are not. The Great Depression was a very difficult time for the economy. 1/4 of people were out of work, and you had rolling 10-year periods where you lost money. Put in $1,000, 10 years later, it was less than $1,000. But here we come out of the World Depression, out of World War II, and the stock market went in 2 directions, up and way up, until you had returns of almost 20%. Is it too late to get in? Yeah. 1960s come around, and we have Vietnam War, and the civil rights movement and the women's rights movement and the gay rights movement. And then you had drugs and sex and drugs and rock and roll counterculture. And then 1970s roll around and stocks are very expensive by this time. And we have Watergate and the first gas crisis, and it all fall down. You see, stocks had been overpriced, and so people just finally got around to realizing that it was a very difficult time for the economy. It was the 1970s, and many of you weren't around, but I was, and I remember there was a time when men were wearing high-heeled shoes. We didn't call them high-heeled shoes. They were called platform shoes, but that didn't last very long. What was the real problem in the 1970s? That stocks were overvalued, as Peter Lynch says, but also the baby boom generation came of age, a big bulge in the demographic composition of the country, and I'm one of them. We all had to get jobs, and we all had to buy houses and get apartments and get shoes and refrigerators, and it was a very difficult time for the economy. And you had a rolling 10-year period that was almost negative. It was just barely positive. And the stock market had lost about 50% of its value. And what did you hear people say? Ooh, is it too late to get out? Right. Yes. Now's the time to be buying. Because we're coming out of the 1970s with the 1980s and globalization and miniaturization and electronics and computers and then telecommunications. And then in the 1990s, the internet and everybody's getting cell phones and the blue skies, technology advances, productivity advances as far as the eye can see, and stocks were going up in two directions, way up and way, way, way up, and you had rolling 10-year periods of almost 20%. And what did you hear people say? I think you know. Ooh, is it too late to get in? Yeah. Oh, yeah. The dot-com bubble burst, then the housing bubble burst, and you had the global financial crisis, the Great Recession. They didn't call it Great Depression, too. But really, it wasn't as bad because of some of the things that the Treasury and the Federal Reserve Bank and other treasuries and reserve banks around the world did to mitigate. It was bad, folks. It wasn't. We were looking at the abyss. And you had rolling 10-year periods where the stock market lost money over 10 years. And you heard people say, oh, is it too late to get... we're humans, right? We're not rational. And sure enough, here we're coming out of it. Now, are we going to do this again? Are we going to do another 20%? I don't think so. It doesn't mean I'm right. It doesn't mean I'm wrong. That's why they call it the future. But I am very optimistic. I will tell you, dear students, I am very optimistic about the next 10, 20, 30 years economically. I am terrified politically, especially if a certain Agent Orange gets back in, because the rise of authoritarianism is not good for economies. It's good for a few people who happen to risen to the top and squash everybody else. So we'll see. We'll see what happens and pray. That's about all you can do. Okay, because again, you got Putin, you got Xi Jinping, Kim Jong-un, and goofball down in Venezuela, and oh my goodness. And it's scary. That's what scares me. So talk to your political science professor, okay? What are the risks of stocks? Well, there's the business failure risk, which means it could default. The company could fail, right? And the company and the stock becomes worthless. There's a market risk where the market as a whole could plummet, but those are actually good opportunities. When everybody's running around screaming and hollering and yelling, if you can remain calm and not panic, those are great times to invest more. But history tells us that it's going to come back. And if it doesn't, if the whole thing cracks and falls and dissolves into a pool of tears, and there's no food at the Vons, and there's no gas at the Chevron station, and there's no clothes at the Gap, and the cell phones aren't working, and the utility companies aren't pumping out electricity, and the trash isn't being picked up, and the sewer's backed up, you know what? You're not going to be worrying about your stock investments, all right? We'll all be digging for beetle grubs and boiling bark for dinner. But I truly believe that that's not going to happen. I really believe that we are looking at the verge of an economic super boom around the world, because most of the world realizes that capitalism might be the absolute worst system ever created economically, except for all the others. Yeah, right. So and I'm old, right? Usually, as you get older, you get more pessimistic as you look back at the good old times, which when you think about them, were they really that good? Then there's the global investment risk, sometimes called foreign risk. Traditionally, most other countries did not have the same standards of accounting as the United States, but that's all changed. Many have better standards than the United States, if you can believe that. And then there's the currency risk about whether the dollar will be stronger or weaker over the next 10 to 20 years. Dollar has been very strong for many years. There was some weakness there, but it's bounced back. And I don't believe that it's going to crash like some people do, where they talk about the BRICS and all this stuff. The global reserve currency is going to be thrown in the wastebasket. No, it's about time that we share the stage, the global stage, with other currencies. The dollar can't be the end all and be all, but at the same time, we're the United States. We tend to take ourselves for granted, or we tend to overemphasize our importance in the world. But we're not going away, okay? Assuming we don't blow ourselves up, die in our own ways, tsunami, meteorite, earthquake, disco returning. Anyway, liquidity risk is usually not a problem with stocks. If you own 100 shares of McDonald's, somebody wants to buy them. There are some very small companies called penny stocks, and there are some examples that'll show you. Just stay away from these. These are scams. They're not real companies. They're somebody's garage in one of those states that begins with the letter I, like Iowa or Idaho or something like that. So don't worry about liquidity. Somebody will buy your shares. How do you reduce the risk of stocks? Well, you know what? Risk is difficult to measure. In fact, it's impossible to measure. It's even more difficult to anticipate. But emphasizing large companies which pay consistently rising dividends has been one of the best strategies for reducing risk. In other words, companies like Clorox or Colgate, really boring companies. How much boring could be toothpaste or bleach? Diversification is another major strategy for reducing risk. The Better Investing Group, which I hope you'll join. If you get involved in investing in any way, you really should join this group. I'm one of the volunteer directors for the Golden West chapter, which covers Los Angeles, San Diego, and Las Vegas, and Imperial counties. The betterinvesting.org 5-stock rule of thumb. Look, you're going to buy 5 stocks. You're going to you need to buy like 10, maybe even 20. But let's say you buy 5 stocks. 1 will do poorly, make you sad. 3 will follow the market, up and down. And the 1 will then explode, and you'll be, wow, that was not the company I expected to do really, really well. So that's been my experience. And then one of the best strategies is time. Over time, our global economy has grown. Our standard of living has increased to the point where somebody who woke up from 200 years ago would just be amazed. It couldn't even work 50 years ago, all the changes we've seen. And so I'm very optimistic. Time in the market, not timing the market, is what makes you wealthy over time. Now, slide number 9. It certainly doesn't help the cause of stock investing that there are many, many scams out there ready to take your money. One of the oldest and still most prevalent is called pump and dump. The scam artists pump up the price of the stock through rumors, lies, innuendos, spam emails, spam text messages. The buzz drives up the stock price. Sometimes they get a celebrity. This is what's going on with kleptocurrencies. I'm sorry, what are they called? Cryptocurrencies and NFTs. You get a celebrity to talk to your particular kleptocurrency. The scammers then dump their shares at a large profit, and the price plummets when the suckers realize they've been taken. Usually, this is reserved in the stock world for penny stocks, which are, as we said, companies that are not real companies. It's a scam, but they get away with it, folks, because why? That's where the money is. And there's the old saying, sucker born every minute. Yep. Now, bubbles. Occasionally, investors get caught up in what are called stock market bubbles, also called manias. The dot-com bubble was the latest stock market bubble, although some people say we're in this FANGs bubble or Magnificent Seven bubble right now. I don't know. Some of those companies are really strong competitors, but yeah, their valuations are just, they're off the planet. They're $3 trillion for one company. That's larger than the gross domestic product of most of the nations around the world. But, you got to hand it to them. They are very, very strong competitors. Who are we talking about? Amazon, Apple, Faceplant. I'm sorry. Tesla, it used to be one of them. Now I think they're kicking them out. I don't know. Nvidia. Who else? I'm missing somebody. Google. I got them. Yeah, I got the Mag 7, I think. The granddaddy of all bubble. And by the way, in the bubble of 1920s caused the crash of 1929. The Nifty 50 stocks that could not lose value, like Polaroid, which is, you still see the name. The people use the name, but the company's been long gone. I would not invest in a company whose name rhymed with hemorrhoid. I just wouldn't do it, folks. Anyway, the bubble of 1920s caused the crash of 1929. Have you ever heard of Radio Corporation of America? Yes, you have. That's RCA. Right? I forget how much. They lost 90% of their value or some 95% of their value. And in the 1840s, there were 400 railroad firms. Now there's less than 5. The granddaddy of all bubbles, though, was the Dutch tulip bulb craze of the early 16 tulip bulbs. Yes, tulip bulbs originally came from Turkey and now are synonymous with the Netherlands. And in the Netherlands, when they were introduced, they became like stocks. They were started to be traded like stocks. Now there's some controversy about how bad it was, but one bulb sold for the value of a house, so that's pretty bad considering that when you put tulip bulbs in the ground, they make more tulip bulbs and more tulip bulbs, and you just keep planting them, you're going to eventually have tulip bulbs coming out of your ears. Each time the phrase was, it's different this time, it's a new era, the old ways of valuing stock are gone, and each time, dear students, they're wrong. There's a wonderful book called Extraordinary Popular Delusions and the Madness of Crowds. It was written in the 1840s, and it still shocks you. Witch trials, the Crusades, the Dutch tulip bulb, the stock companies of that day, of those days, that were bubbles, and you just wonder, like, why do these things keep happening? It's human nature. Oh, is it too late to get in? Oh, is it too late to get out? Greed and fear, greed and fear. Slide number 11. How about taxes? Well, actually, stocks have a very honored and privileged position in the tax world. That's because of Republicans who have been pushing this for since 1980s or so, because the rich people own stocks, and so they want the taxes lower, and so they got their taxes lower. Short-term capital gains are taxed as if you were earning the money, which is another reason why you shouldn't trade. Short-term means within a year. Anything above long-term means a year and a day. You hold the stock for a year and a day, are taxed at a much lower rate. It's been a very big difference for the very wealthy. And then dividends were traditionally taxed as income like interest payments, but now they're taxed at the same low rate as long-term capital gains, which again, surprise, has been a huge windfall for the very wealthy, which leads people like Warren Buffett to say, look, this is not right. I shouldn't be paying a lower percentage of my earnings than my secretary, which is, he said that famously. And of course, people like Elon Musk say, I don't want to pay any taxes. Oh, look at what I've done to this country. And so, what are you going to do? I know. What have you done to this country? Slide number 12. Where do you get your stocks? Where do you buy your stocks? Well, it used to be you had to go through full-service brokers, but the 1970s, they started opening things up to discount brokers. Now we have the deep discount brokers, which we don't call them anymore. Those are the Robin Hoods of the world. Now Schwab, because Schwab had to follow Robin Hood's lead. There were two companies before that tried to offer free trades. but they didn't succeed. But then Robinhood did, and I think more because of the gamification, turning it into a little video game, and saying people, "Oh, it's free to trade." Don't believe them. Don't believe them. Do you really believe it's free to trade? No, they're just hiding the fees, and we learn about that in detail in Business 123 because we don't want any of our Business 123 Introduction to Investment students telling anybody that their trades are free, or when someone says, you come over here, it's free trading. No, it is not. They learn how to explain it. There are other low-cost options, such as what are called dividend reinvestment plans, DRIPs. I love that name. I want a DRIP. Yeah, you want a DRIP. Uh, they will reinvest your dividends in additional shares free of charge, or we used to have a DRIP with Sempra Energies, SDG&E. And it was mostly free, but then every quarter or so, every once in a while, we would be charged 6 cents or 3 cents or 9 cents. So I thought, well, that's about as close to free as you can get. And then you can actually hold your stocks in certificate form, but don't do it. Don't do it. Don't do it. That's only the same. Only people who stuff their money under the mattress would want to do this. Yeah, because it's very difficult. Now, some companies don't even want to be bothered with you. So go on the website, take a look at some of the stock certificate examples because they're actually pretty cool. The most sought after stock certificate was Disney. And people would buy one share of Disney and then ask for a certificate. And Disney got tired of this and said, okay, no more, no more. But they were cool. Check them out on the website. They were very, very cool. Okay, now we're going to take some time, stretch, because we got a few more minutes to go through various classifications of stock investments. We're going to go from the least riskiest and then down to more riskier stocks. You might have heard the term blue chip stocks. These are safe and in companies that have been around for decades and respected. They're often referred to as value stocks. They attract conservative investors. And now when we use the term conservative in the financial world, we're not talking political conservative. We're talking about people, they want to invest in stocks, but they don't want to lose a whole lot of money. So companies like GE, General Electric, which, has a storied history. It was one of the first stocks in the Dow Jones Industrial Average, which you hear about every day. It's long since, not long, but it left a few years ago. And it's been broken up, so it's not the same company, but it's still, they're not going anywhere. AT&T, which again had a long storied history and then kind of got broken up and then come back together again. And Coca-Cola, which never got broken up, but did make some stupid mistakes. But they're still around and they'll never go anywhere. In fact, Coca-Cola is the second most well-known word in the world. The second. The first is an English word. It's okay. Yeah, it's a great word, isn't it? Okay. It just says it all. And then the next category are income stocks. These are typically slow growth companies in mature industries such as utilities. Utilities growing that fast, not normally unless the area they're growing is growing quickly because people don't want to take cold showers in the dark. Banks. Banks are pretty boring. At least they were for many decades until they made them exciting. And that's when we had the global financial crisis, the Great Recession, because we let the banks do things that we knew should, at least people like me who were jumping up and down and saying, this is dangerous. And other people were saying, oh, he's just an old fuddy-duddy. He's keeping us from financial innovation. Even Alan Greenspan said he was totally blindsided. Totally blindsided. Just could not believe that if they did the things they did, that would happen. And then he realized, boy, were we stupid. It's interesting. Utilities now are coming back to life. Why? Because of artificial intelligence. All the chips being produced to do all these huge data centers that consume unbelievable amounts of electricity. And the utilities are saying, what? You want us to do what? So that's why companies like Microsoft and Google and who else are investing in nuclear reactors because they're going to need a whole lot more electricity. So maybe utilities aren't boring anymore. We're going to see what happens. And of course, people want to buy electric cars. I mean, if I buy another car, which I don't really want to anytime soon, I hope my car outlives me. But if I do buy another car, it will be electric. But I'm going to make it a solar car. They're coming down the pike, folks. They're maybe next year. Yeah, look up aptera.us. Very cool. Anyway, slide number 14, growth stocks. These are the stars. They're the companies that are on the cover of Gentleman's Quarterly and Vanity Unfair and Vogue. These are the companies that are earning average profits, above average profits. Growth rates of 15 to 20%, which doesn't sound that much, but if you were growing at 20% in 3 years, you'd be almost twice as tall as you are now. Usually they're not paying dividends or a very small amount. Most of the profits are reinvested in the company. You accounting students know what that's called? Retained earnings. Yes, the stock price should go up as the business grows, but the stock will usually be very volatile, which is a fancy word for, I lost a lot of money. So examples would be Intel, Hewlett Packard, and Dell. Wait a minute, are Intel, HP, and Dell growth stocks anymore? Well, they were 30 years ago, but now HP, who knows what's going on with them? They can't sell as many printers as they used to. Intel's trying to reinvent themselves and coming out with some pretty amazing chips, but they're really kind of lagging behind the other chip manufacturers. And Dell, well, they're battling it out in the personal computer market, and their laptops are some of the most sought after, but they are working on those data centers for the companies that are doing the artificial intelligence. So who knows? Maybe Dell is going to have a major upswing. We'll see. But who are the growth stocks now? NVIDIA, Apple, Amazon, Google, Microsoft. Those are the stars, are the people you hear about every year. I mean, not every year, every day on the business internet websites, the financial websites, and the like. Now, on the other side of the coin of growth stocks are what are called cyclical stocks. Huh? Are these round companies? No, these are companies that follow the business cycle of advances and declines in the economy. And any company that makes stuff is considered cyclical, like Aluminum Corporation of America, Alcoa, USX, United States Steel. Automobiles are the poster child for cyclical companies. Why? The economy's doing well, people are getting raises, they are all employed. What do? I want to buy a new car. I want to buy, how's the old car? Oh, I know, I like that new car smell. I want a new car. The ashtrays are dirty. I want a new car. When the economy hits the skids, what happens? Oh, that car out there, old Bessie out there in the driveway is doing just fine. Thank you very much. So automobile companies make a ton of money when the economy is doing well, and they lose a ton of money when the economy hits the skids. And now computer chips. Yeah, because everything you buy now has a chip in it. So they are more and more cyclical, except for the AI. That's all growing like crazy. So cyclical companies, any company that makes stuff. Now, what about defensive stocks? What are these? These are companies that we're not talking about bullet makers. We're not talking about tanks and those kind of things and jet fighters. We're talking about companies that are very boring and everybody needs no matter what, like Kellogg's or Procter & Gamble or Pfizer. So do you eat more Cheerios or cornflakes because the economy's doing well? Do you eat fewer Cheerios? You need food. Procter & Gamble, soap. You need soap, right? You need Head and Shoulders and Tide and Pampers and Gillette razors. And then drugs. Do you take more insulin because the economy's doing well? No, you're the insulin the doctor tells you. So, but drug companies are a little funky because they have their own little cycle of when they get a new blockbuster drug and then it goes off patent, they have to come up with a new one. So drug companies are a little strange in that respect. And then speculation, folks, is a fancy word in our industry for, oh, I lost a lot of money. Yeah. They may make you rich overnight. They might turn $1,000 into $20,000 or maybe turn it into $20. And so these are the stocks people think they need to get into. And you know what? Good luck. Never worked out for me. I was a sucker in the late 90s for some of these um, biotech companies, which were doing unbelievable things, folks. And oh well, it didn't always work out that way. You know, one of them is going to do really, really well, but 5 or 6 or 7 or 8 or maybe 12 of them are going to fail. And if you don't believe me, let's take a look at I'm sorry, GoPro. GoPro, where is it? Here it is. Is this it? Yeah, here it is. I got it ready. This is Yahoo. Yahoo Finance, which used to be really good. It's still pretty good, but it's not as good as it used to be. And you can put in a quote right here, and there's a presentation on how to do that. So we're going to take a look at Go Broke. I'm sorry. I didn't mean to do that. Okay, come back here, 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 go all the way up. Hey, here we go. Quote, look up. And I happen to know that the symbol for GoPro is G Pro, but I'll start typing in the word, and it will say, oh, you want G Pro, GoPro. And if you know anything about sports, you know that GoPros are the things that you put on your helmet if you're a motorcyclist or if you're skydiving and they work underwater and the like. And they're very cool, but they're pretty expensive. And one of my students was really very keen on this company. And I was saying, well, you know, basically it's a camera, right? And so why isn't Canon or Samsung or Apple getting into it? Well, the reason is because once everybody who owned a GoPro, there wasn't any more market for it. It's mostly for the sports crazy people. So let's see what happened to GoPro. It came out of the chute and at about $40 and zoomed to a peak of 93.7 and then had a bit of a heart attack and then had a real heart attack. And now it's selling for $1.34. Can stocks make us very sad? Yeah. How about Bluebird Bio? That's one. I didn't buy this one, but it's one of those biotech companies that was going to make it rich and didn't work out so well. Blue is the symbol. And sure enough, we're going to see another kind of wonderful disaster. It came out of the chute and hit a total of 107, 125, and then 132, and now it's selling for 48 cents. So my job is to get you not to buy these speculative companies. Maybe one or two, you know, who knows, but you know, stay away from these. That's why we talk about companies like Packaging Corporation of America. What do you think they make? Cardboard boxes. You know, you want to invest in Amazon? When your next package comes from Amazon, turn it upside down and see who made the cardboard box. They've got some competitors, but they've been around since 1867. How about Waste Management Incorporation? Waste Management Corporation. What do? They pick up the trash. Is somebody going to be picking up the trash 30, 40 years from now? Yes. Are they going to be on Faceplant 30 years from now? I don't know. Or Titter? I don't know. I hope not. But hey, we'll see. But somebody's going to be picking up the trash. Slide number 16, a turnaround stock. These are, I call them goners. They're usually companies that have fallen on hard times. And what you have to ask for yourself, is there potential for a rebound? It has to come back. You hear people say that. No, it doesn't. It doesn't have to come back. In the early 1980s, Chrysler's cars were so bad that the company literally almost went bankrupt. They needed a bailout, which really wasn't a bailout. It was a guaranteed load from the government. And they came back. A gentleman by the name of Lee Iacocca brought them back. He was the guy who actually was the project manager, brought the Ford Mustang, a car that's still in production for 60 years. GM, Ford, and Chrysler were all turnarounds after the Great Recession. And there were people who said, let them all fail. Let the whole thing fail. Well, that's the problem with economics. You can't go back and try it again and see what happened if they hadn't failed or if they had failed. And so the government did it again. They gave them guaranteed loans, which means that somebody else lent them money. But Ford didn't take the money, by the way. GM and Chrysler did. And if the loans would have failed, then the taxpayer would have been on the hook. But there's a lot of people, myself included, who think, it was a good idea. Do you know how many people are employed by the automobile industry? Yeah. And then there are companies called asset plays. These are companies that are sitting on an asset that could be sold or spun off. For example, J.C. Penney's. Again, another company has been around for over 100 years. They had an insurance division. They had an insurance division called Stonebridge. They're the company that sells you the Gerber baby, right, insurance for your child. It's very profitable, and they were able to sell it off to raise cash to keep the company afloat. Now, how long will JCPenney stay afloat? I don't know, but it doesn't look good for them. They're getting hit from the bottom by the Walmarts and the Targets, and from the top by the needless markups and the Nordstroms. So we'll see. But I know the one JCPenney's in Fashion Valley, is going to be turned into condos, right? Isn't that that's what I heard? That's what I read. And then the penny stocks, the butterfly.coms, these companies that are not real companies, stay away from them. They are just scams. But there are thousands of them, folks. And somebody's going to try to sell you if it's only 7 cents. Oh my God, I think it's going to go up to 20 cents next week. And then it's going to go down to 0 cents in the week after that. After we sell all the stock that we sold to you at 7 cents, we're going to then just and it goes up to 20 cents, and then we're going to dump it all, and you're going to be left holding the bag. So stay away. So lastly, in the face-to-face class, we would ask people, hey, what kind of stock is Johnson & Johnson, ExxonMobil, Google, Sempra, SDG&E, General Mills, International Paper, Union Pacific Railroad, General Motors, Flim Flam Incorporated, or General Dynamics? Is it a blue chip, income, growth, cyclical, defensive stock, turnaround, asset play? Penny stock, well, the problem is some companies fit neatly into one category and some don't fit into any category. Johnson & Johnson, what do they make? Well, they split up into two companies. They're a drug company now and a medical devices company, but the other part of the company, which is now, what's it called, Kenshaw or something, it's a strange name. They're the ones who make the Band-Aids and the Q-tips and the baby powder. They're a defensive company, right? Because it's medical and the consumer products. You need this stuff whether the economy is doing well or not. ExxonMobil, well, by the way, they're also a blue chip stock. They've been around for 150 years, something like that. ExxonMobil, another blue chip stock, but they are cyclical, huh? Well, they make oil, right? They drill it out of the ground and then they refine it and they send it off to the places that need gasoline and oil products. So the more the economy is growing, the more need for oil. The less the economy is growing, the less need for oil. So they are cyclical. How about Google? Google is a technology company, so it's in the growth part of the economy, growth part of the economy. Are they a blue chip now? Well, many people would say yes, because they're a whole lot bigger than Exxon and Johnson & Johnson combined. Other people say, oh, they've only been around for 20 some odd years. Oh my goodness, no. Yeah, blue chip. Where does the name blue chip come from? Because gentlemen, before the 1920s or so, were the only people who owned stock. And gentlemen gambled. That's what a gentleman did. And at the gambling tables, blue chips were the most expensive chips. That's where the name came from. It came from gambling. Sempra Energy, SDG&E. Right, utilities are defensive because people, and they're income oriented too. They're income oriented because people need their cold. They don't want to take cold showers in the dark, so they're also somewhat defensive, but somewhat cyclical depending on where they are. But in general, we consider utilities income stocks. But as we said, who knows what's going on with the growth of artificial intelligence and the need for electricity? So the utilities might wind up being growth stocks in the next several years. How about General Mills? What do? Cheerios, Wheaties, right? They make foodstuffs. So they are definitely defensive. And they've been around for, I don't know how many years, 100 years or so. So they're a blue chip also. International Paper, another company has been around for decades. They are cyclical. Why? Because they make stuff. They make wood products and paper. When you make paper, you make wood products. And when you make wood products, you make paper. So they're a company that makes stuff that goes into the building of materials, building of houses and the like. and so they are very cyclical. How about Union Pacific Railroad? Well, again, there's another company that's been around for maybe 180 years or so. Maybe, wait, was it the 1840s it was created? Um, they're a blue chip stock, yes, of course. And railroads are cyclical. Huh? Well, because the stuff has to get to the place where it's going to be produced, the raw materials, and then once it's produced, it's got to get to where it's going to be sold. So railroads are cyclical, but they're also asset plays because they've been sitting on land that was given to them almost 200 years ago. Many of them own large swaths of downtown cities around the country, which they were going to build that Chargers Stadium right on where the railroad's sitting. And I think it's not Union Pacific. I think it's Burlington Northern who owns it. But still, it's can you imagine how much that land is worth now? Yeah, so they're an asset play. How about General Motors? One of the bluest of the blue chip stocks until they started making really bad cars, and the Japanese were able to undercut them and show the world how to make really reliable cars. But now GM makes much better cars than they did 50 years ago. And they were kicking butt in China. They were beating all the other companies, the German companies and the Japanese companies in China. But now the Chinese have decided that they wanted their own automobile industry, and they're undercutting everybody. So the Germans and the Japanese and the United States are all worried about how many millions of cars the Chinese are going to flood the world with. So what would we call GM? Well, because it's a car company, it's a cyclical company. But in time 2009 or so, it was a turnaround. It was almost a goner. What about Flim Flam Incorporated? Well, it's not a real company, folks. They make Blue Steam, which is going to be a whole lot better than the left-handed smoke shifter that they were hawking at the world. Some of these companies they're just scam artists. So stay away from them. When anybody tries to get you to buy a penny stock, just stay away. Because some people think, oh, I can beat them at their own game. No. If you don't know who the patsy is at the poker table, the patsy is you. So you think you're going to be able to beat them. You're going to be able to get out before they get out. No, they're watching every trade. They know exactly what they're doing. And they're going to skin you every time. And then what about General Dynamics? What do they make? Ships, battleship. Well, they don't make battleships anymore. But they make tanks and jet planes, and they're a defense contractor. And so where do you put defense contractors? Well, they're certainly a blue chip company, and they pay a decent return in the dividends. But they're their own. They have their own cycle of geopolitical machinations. So that's an example of a company that's very difficult to put in any one of the categories. Yeah. So has this piqued your interest, or have you just sat through a mind-numbingly boring presentation about stocks, which you don't care about? Either is fine. Either is fine. Because if it does pique your interest, that's a very good sign that you could become your own financial advisor. Or even better yet, the industry needs you. A whole bunch of us old guys ready to retire or die, and we need new professionals. More women, more bilingual, more bicultural, minorities, veterans. The industry loves veterans. Why? Because it's a very structured, very regulated industry. And who better than people who thrived in a very structured world, because the military world is very, very regulated. So we need you. And think about it, folks. Even if you don't like this, that's fine. We're going to talk about mutual funds eventually. Remember, we talked about them last presentation in chapter 11. We're going to discuss them again when we get to chapter 14. Somebody will pick the stocks for us. But stick with us, because what we're going to hopefully show you is that it's really not as hard as intellectually people think it is. Emotionally is where that's where we can get, is it too late to get in? Or, is it too late to get out? Don't panic. See you on our next presentation. Thank you so much for being in our class, dear students. We are so proud of you.